Well, hi, it's Chris here from Capital Counts and welcome to another edition of Meet the Fund Manager Investment Series. Today I'm kindly hosted by Rowe Price. Rowe Price is in a lot of our portfolios. They were established back in 1937 by Thomas Rowe Price himself, and a very strong background in global equities, investment strategies, fixed income strategies. Today I'm kindly with Sam Ruiz. Thank you very much for joining us today.
Great to be here in the flesh, Chris. It's been a while.
It has been a while. Well, just as a bit of a backdrop, obviously with markets where they were, we had a terrific run up until 31st of December last year. Markets were pretty kind to us, portfolios responded accordingly and they were very sound. We come into the new year, we've got Russia, Ukraine, high inflation, higher interest rates. What's the general comments from Rowe Price around those sort of issues?
Yeah, I think firstly we have to acknowledge that we've seen huge extremes throughout two periods of COVID. So initially, markets love liquidity, markets love low rates, and we've seen a historic reaction from central banks around the world to inject more liquidity than they ever have. I don't think anyone expected us to avoid a prolonged recession because of COVID. I don't think anyone expected that we were going to have consumers and corporates in a better position with more money in their bank accounts, more customers, more revenues during COVID. So that's unusual, and that's why we saw markets do incredibly well towards the end of December. Those dynamics of liquidity and low rates have shifted markedly. So if we go back to the end of December, we had an expectation that the US might hike rates 2 times in 2022. That's now closer to 8 times. Some people expecting 10 rate hikes. So that is something that puts pressure. Very simply, if you have higher interest rates, higher mortgage repayments, that really hurts house prices. It does the same to equities as well.
So where do you see markets now?
Yeah, the thing that's changed is the valuation of equities. We had valuations at quite extreme levels towards the end of last year. They've come down quite meaningfully now. So we're getting closer to the longer term average, which is a better starting point for equities at the outset. The issue right now, and I don't have an answer to this, I don't think anyone does, is people were worried about inflation and interest rates. Now the market's worried about whether we go into stagflation, which is a period of very low, if not 0% growth and high inflation, which is a terrible environment, or potentially recession, because central banks need to fix inflation. They can't fix the supply conundrum. You can't just get the supply bottlenecks to ease immediately. You can't get China to open their borders and stop locking down. So the only way to bring inflation down is to crush demand to meet the lower levels of supply. So the big debate now is, to what extent do we see a recession? How deep and prolonged will that recession be? I don't think it's helpful for us to say what our even base case is, because there's so many variables to that. But what I would say is global growth is still quite strong. Earnings growth of companies, and that's what drives markets, is are these companies still seeing more customers, positive margins, positive earnings and cash flows growth? What we've just seen is the US earnings season for the first quarter of this year pretty much finalised. There's a few companies to go, and we saw that the companies delivered around a 14% earnings growth on a year-over-year basis, and that beat expectations by 7%. So global growth, economic growth for now is strong, and companies are still doing well. The problem is the variation of the winners and losers has just become a lot more extreme, and that's where we come in. Our job is to really get under the covers and figure out how we align with the companies that continue to win in this environment, and think quite hard about which companies might actually be disadvantaged in this new environment.
So you mentioned winners and losers. So what are some of the themes or stocks that you are looking at in a higher inflationary, higher interest rate environment?
Yeah, I'll pick out one. There is, as in one on something that we'd avoid right now. You've seen Netflix. Everyone knows Netflix. It's down 50% in April alone. This is a company that had 2 single-day drops on the market of around 25%, which is just unheard of for what people call blue chip companies. This is a company that during COVID, people were thinking, we're going to see more people consume digitally than we've ever seen before. We're going to see new countries come online for Netflix. They're going to accelerate their subscriber growth. Netflix just came out last month and basically said, we thought we had years worth of new markets to tap. We've just realized that we've pretty much saturated the world. it's an exaggeration, but there's no new Netflix customers for us to even gain. So we're thinking hard about avoiding some of these very big, strong innovators that have been very disruptive, that are entering new markets, but where COVID has potentially meant that they've pulled forward years worth of growth, and that growth is now stalling. That's not a great environment to be for, for companies that typically have been at very elevated valuations, where people are happy to pay for very strong long growth. Where we're thinking now about where we want to be exposed is we want to be a little bit more defensively positioned in the portfolio because the risks of recession or stagflation have increased. And we want to think about how, if the inflation dynamic has changed in the world, what are ways that we can give investors exposure to inflationary beneficiaries, but also protect the portfolio from underperforming if inflation goes much stronger.
And just any other sectors that you're sort of looking at, like, for the benefit of our viewers, what other sectors are we looking at?
Yeah, we don't tend to think at a sector level. We go company by company to see where those prospects might be better. In financials, we're thinking very carefully around high interest rates. Traditionally means companies that are linked, whether it be banks and that do lending, that they can have stronger net interest margins. But we're being very cautious where we can get exposure to some companies that can give us that leverage but don't have credit risk. So we've got an equivalent of, I think a lot of your clients would know CommSec. We've got the US largest equivalent called Charles Schwab that makes a lot of money as interest rates move higher. When you and I might have shares in our account and we get paid a dividend or we settle a trade, we often leave $100 or $200 in there, we don't even know about it. And they basically make a spread on that. They don't pay us any money on that cash. But we're avoiding the banks now, where high interest rates mean they make higher near-term profits. But all of a sudden, if their client base or customer base realises that their mortgages have just gone from 2% to 4%, you start to see a higher risk of credit defaults and new provisions coming from the banks. So we're really cautious of the credit side, but we want to get exposure to the interest rate side. It's very widespread. There's a whole range of other opportunities. Particularly, I would mention there has been nothing short of carnage in the tech space and the software space, with all these businesses that are much further out in the future, their growth being really sensitive to interest rates moving higher. We're getting to a point now where we've seen something equivalent to a tech bubble sell-off in some of these areas, and it's starting to get more attractive there, where I'll give you a great example, Shopify. Shopify is effectively a competitor to Amazon, where you pay them $30 a month and you can get an offline business completely online, shipping to customers, in a matter of weeks. This is a business that is trading now at a fraction of the valuation it was trading before COVID, yet despite what's happened, they've got 300 to 400% growth in the number of people using their services. That just feels like a bit of an extreme sell-off where we are today. So in these periods of big market sell-off, there can often be very good opportunities now if you reset for the next 2 to 3 years.
Okay, perfect. Well, Sam, thank you.
Thank
As
you, Chris.
always,
Good to be
appreciate
here.
it. Again, if you'd like any more information on Rowe Price, please give us a call on 1300 882 166. And also, obviously, be prepared. 30 June, fast approaching. Please give us a call just for any end of year tax strategies. All the very best. And again, thank you very much, Sam.
Thank you, Chris.
Cheers.